finished the Chapter 19 ethics one, and I'll start this one, and we'll see where we get through on this one. Here's what I'd like to do on that one. This one's on end of the audit and reporting, and that's a huge amount of. We can go through something that has a fairly large representation on the CPA exam in a fairly short period of time. It's kind of like ethics in that it's more dense than some of the other topics. So anyway, we'll see if we get through that. And then next week's our last class, and I'd like to get a test. I'll decide. We'll decide what to do with it, about a test for this. Certainly, there's going to be a test on the Chapter 19 handout of ethics. For this one, I might add a few questions on. We'll see how far we get or what we get through. But anyway, it's both these I think are pretty good stuff. And neither of them are I don't think are as difficult to like internal control, but they're yeah. Okay, so we got through 15, or I scratch that. We got through page 5, unless I wrote a bunch of stuff. Okay, I think we're on the independent. I think it's on top of page 6. Is that correct? All right, on independence, employment interest of family members and close relatives. Okay, so and one of the things I should put on here is that so these are people who are either your immediate family or the close relatives, and conflicts of interest you can have if they are. Oh, I got to put the poll up. If they are in the if they're employed by the company. All right, family members and close relatives cannot occupy, and this used to be called key positions, but they've kind of defined it a little bit more closely to be key financial. See in the client space, with the client. So it used to be to say key positions, but lately they've kind of defined it a little bit further. You may have somebody who actually is pretty high up in a company who has no, they're the artistic director or something. They have no relationship to the financial statements. So this has been kind of defined as key financial positions. Okay.
Are you saying family members and close relatives of the audit team or of who?
Of covered members.
Oh, covered members. Okay.
I should put that somewhere in there. Good. So I just added that part in. Thanks to you, Jason. So you're closer. So family members or close relatives. It's only for key financial positions that it can be a problem. So if the idea is, I think actually I put it in one of the exams that there was a niece that was stocking shelves in one of the stores that of a client. First of all, the niece is probably not considered a close family member or close relative, but not only that, it's not a key position. Someone stacking the shelves is not going to have any influence over the financial statements. So there's no problem. It isn't that no one can work for the company. It's that they can't be in a key financial position. Okay. And there's some places that have if they're basically a one factory town, like I don't know if it still is, but Peoria I think was John Deere, Caterpillar. I think it's kind of Caterpillar, but they try to find someone who doesn't have a relative that works at Caterpillar. I mean, half the city works for Caterpillar. So as long as they're not in a key financial position. Okay, now, so these, so on the multiple choice, the first 5 just put in nothing or just put an E or something in. It doesn't really matter. But so 16. So starting with quick question 16. Yeah, so you can just put E or something in for all those. Or no question exists. No, I should put no question exists for the first one too. Now that I think about it, because this might come up again. Okay. Sam is a member of the UP1 Corp Audit Engagement Team. Sam's mother is a Chief Financial Officer of UP1. Is Sam in violation of the independence rules?
Would we say yes?
Yes.
Yeah, it's a key financial position. That's a key financial position. Yep. I can't remember how I did this. Like, I'm gonna peek. Oh, I did it in green. Darn it. I did it in green. Oh, and I got the question. Around here. Mary is a member of the UP. Mary's father is the director of design. Oh, I just talked about this. Is Mary in violation of the independence rules?
No.
No, it's not a key. If they have no influence over the financial statements, which I kind of doubt the director of design probably does. So probably not. I mean, now if you find out that they do, then it's a problem. But yeah, and this is and this is one of those things that it does disqualify people from working on an audit, and in some ways it's unfair, but in the other way, there's nothing you can really do about it. I seriously doubt that Sam's mother is going to stop being the CFO. So that Sam can do an audit. Okay. Now, independence financial interests of non-covered members. So here's the thing. Just because they're not covered members, does that mean that everyone else is off the hook? And this generally relates to partners and professional staff, usually. It does not usually go down to, say, secretaries, janitors, and all the support people and all that kind of stuff. So this is for partners and professional staffs, usually the people who have gone, college degrees and that sort of thing that are working in for the profession. So let me do something here. Okay, so what we're really talking about is, all of these people. These are not, they're not covered members. But they, they don't have as strict of rules, but they do have some rules. And the rules are basically, they have to have a much higher involvement than oops, that's fine. So we're talking about all the people in green here. So the covered members are all in yellow. But these other people, they have responsibilities too. And this could be even in office, an office in wherever, San Francisco, Detroit, wherever. Anyone who is, partner, manager, senior, associate, these rules apply to them. So these are for non-member, not covered members, but other people in the group. Okay. Financial interest. So financial interest, the big one is non-covered members may not own more than 5% of the client. Now, for poker trade companies, that's, like I said, it's probably not relevant. I mean, if you own 5% of a poker trade company, you're probably not working for a CPA firm. But the non-covered members, they may not own more than 5%. If someone is a non-covered member that does own more than 5%, the entire audit firm is not independent. So this is one of those weird, this does not relate to a covered member. This isn't like a family member of a covered member or a relative of a covered member. This is anyone who's a professional staff who's not a covered member, anyone in the firm, and it relates to the firm itself. The firm itself is not independent. So again, this doesn't relate to a single covered member, like family member or relative or whatever. This means the entire audit firm is not. Okay, so employment. Any questions on that? I'll tell you where this can come into play, especially if you're in if you're a smaller CPA firm or a smaller area, that you may have someone maybe their family business is owning grocery stores and you do the audit. You may have somebody on the audit team that owns 10%. Is a 10% owner in a grocery store or whatever it is. So you can run into these things. For poker trade companies, much less likely, but again, it can happen. You can have somebody who, they went to, they're not going to be in the business, but they went to, but they still have an ownership of the family business. So it isn't that it never happens, it can. Okay, employment interest. Non-covered members. cannot hold upper management or oversight positions in the client or with the client. That is a better way of saying it. So upper management, kind of obvious though why they can't have upper management positions. But oversight positions are things like the board of directors, audit committee, and that sort of thing. There's an exception to this, which I'll talk about in a minute. But so generally, you can't have upper management or oversight positions with a client. So if you have somebody who is on the board of directors, it's a no-go. No, I just I just gave away the number 18. Okay, number 18, James is a senior auditor for the CPA firm that audits IBM. However, James is not a covered member for the audit engagement. Okay, so James is a senior auditor. He's not on the engagement, so he's a non-covered member. James is also an ordained administrator in this position at IBM Board of Directors as a spiritual director. Okay, a lot of times board of directors, they'll try to get a mix of people on board so that they can, because they represent a lot of different interests. James is not on the audit committee at IBM. Will James' position impact CPA firms' independence? What do you think?
Yes.
Yep. And it doesn't matter why they're on the board of directors. If they're in an oversight position, I mean, it may have nothing to do with the audit. It probably doesn't. But they cannot be on the board of directors. And not to put too fine of a point on it, they can't be on the board of directors for even one day in the audit period covered or in an upper management position. So if somebody is on those positions during the year, they can't do the audit period. The entire CPA firm is not independent. Okay. Yeah. There is an exception to this. And I've seen it a couple times on the CPA, on some of the CPA questions. I'm not sure if they was tested very often or not, but here it goes. And that is if the nice honorary, is it? There we go. If the board of director position is purely honorary, then it might be on. As long as you're not making any decisions, you're not required to make any decisions. This happens a lot of times on things like not-for-profits. You know, sometimes because CPAs a lot of times are members of the, you know, are deemed as upper whatever of the community, pillars of the community and so forth. It's possible they give you an honorary direction that you don't vote on anything, you don't have a vote in the board of directors, anything like that, but it's an honorary position. And they do this so that, you know, for fundraising and things like that, that they can show a number of people on the board of directors that are, you know, that associated with them. If it is purely an honorary position, in other words, there's no voting, you don't go, you know, attend the regular meetings or anything like that, then it's allowed. But usually what we're talking about there is usually for not-for-profit kind of organizations that may do it for fundraising or something like that, that they like to have a list of a whole bunch of people on there, and so sometimes they'll want to have your name on. That is an irritating phone. All right. Any questions on that? Okay. Independence issues. Past due professional fees. These, if you think of it, so past due fees are a real problem because it gives you a financial interest in the client. So if they have not paid their bill, you can't do the audit because you're not independent, because you have a financial interest in them. You know, you want to get your fees. They impact. They are firms of independence, and then basically they have to pay their fees, or else you can't do the audit. You have financial interest. It'd be in your best interest to give them a clean audit so that they could get financial bagging, so they can pay your bill. And so past due financial fees will are generally considered to impact the independence. Now, we're not talking about disputes in bills. You know, if they paid 98% of it, but they're arguing over time that was spent on whatever. That's not what we're talking about. We're talking about if they haven't paid a significant material amount of the professional fees. And it is also possible that getting a new client that CPA firms will lowball. They will give a purposely low, introductory rate for the audit. So how much you paying for your audit? And they say we're paying 3.2 million for it. And you say, oh well, we can do it for 2 million, even though 2 million they're going to lose money on, and that's kind of called buying clients. It is possible that those also are affect independence, because you are now on the hook to try to make up that introductory fee. Every year you kind of inch it up a little bit, but so it is possible that if there are for a now, do CPA firms do this? They do it all the time. But so we're really talking more about a matter of amount. But a lot of times CPA firms will do it. And even if they charge the normal rate, a lot of times they'll lose money in the first audit, because they have to do a lot of background work in this early. Okay, gifts. Probably guess this is gifts are okay if they are immaterial. This is not the IRS's definition of immaterial. I think the IRS is like 20 or 30 bucks or something like that. So gifts are allowed if they're immaterial. And they're also allowed if they are usual in the circumstance. And one of the things that comes up a lot are things like golf outings. Some of these golf outings, some of these places they play golf are crazy expensive, thousands of dollars. But if they are usual in the circumstance, in other words, if it's allowed if it's one of those things that is expected, and that the circumstance is such that it's a normal part of the business, for example. So allowed in the circumstances. And again, these are kind of vague terms, but I think the biggest one that comes up is golf. Because these golf fees are, they can be thousands of dollars. And they probably are material, but the circumstances such is that they, and a lot of times, especially if it's an outing where they have several people from the company, that sort of thing. Litigation. Some of these are kind of obvious. I don't know how much I should go into them. But, oops. Litigation is you have a lawsuit with a client. That could make you not independent. Lawsuits, another one is lawsuits between clients. You have two clients that are suing each other. It's quite possible that litigation may make you not independent as far as one of them or both of them. Well, it probably would be one of them. I probably have to choose which one. But lawsuits between clients can also affect the independence. Non-attest services. Yeah, I actually want to cover this later. Reporting illegal acts. I think we've talked about this before. We've talked about this before, I'm sure. Reporting illegal acts. You generally, you report to upper management. If they don't do anything, you generally get a lawyer. If it's a non-issuer, you get a lawyer. I'll write it. Okay, so reporting illegal acts. You report it to upper management and the board of directors. And if the client does not take appropriate action, non-issuer. You're a lawyer. Because you may be required to report to the police, you may not. And you certainly would probably want to know what to do though. If it's an issuer, report to the SEC within 24 hours. So they have a day to think about it. If they don't do anything in the day, you report it to the Securities and Exchange Commission. Subpoenas. Yeah, I'm goofed it up. CPA firms must comply with actual subpoenas. These can't be just letters or anything like that. They have to be an actual subpoena. They have to go to a judge and get a subpoena. In most states, I guess there are some states now that are granting the same confidentiality that is given to lawyers to CPA firms. I'm not sure how that's going to play out, but I guess there are a few states that are doing that. So, but most states, if you get a subpoena for records, you must comply with it. Contingent fees. I think I talked about these also before. 100% positive.
I don't think we talked about those.
Yeah. Contingent fees, you can charge them in most circumstances. Not allowed for audits.
Was there an answer for the non-attest services consulting engagements? That's allowed, right? Or not?
Actually, I postponed that because we're going to talk about it
Okay.
here.
Oh, later.
Yeah, it's going to be on this non-test services for audit clients. I did the chart that's a little more. Yeah, if it's a issuer, they're generally much of them are not allowed. If they are a non-issuer, then most of them are allowed. But we'll talk about it. I'll write on here. See below. Okay. Things that are not allowed for tax returns. You cannot say split a tax refund with the client. And they're also not for compilations, which are really just creating financial statements. So compilations used for creating they're just financial statements. Compilations are basically making financial statements for the client. And if those statements are going to be used for loans or investments, you can't do those for contingent fees. You know, for instance, they can't say this compilation, $300 for the compilation. Tell you what, if we get the loan, I'll give you $3,000. You can't take it. Okay, extras creditable. There's a few of these. I'll put some of the ones that you'll see sometimes. Must pay. They can take away your membership and your license if you must pay your taxes. One that relates to us a little bit is
who's paying the income taxes, the firm or the client?
Individuals. So I should say individuals. These are sort of like kind of rules for the individual, keep the individuals aligned so that they don't sully our profession. So individuals must pay income taxes. For instance, they can yank your license if you don't pay income taxes. You say, well, wait a minute, it has nothing to do with that. They say, look, you're a professional, you're supposed to, be a member of the community and all this kind of stuff, and they can pull your license for it. ACCT433 can kick you out. Asking or telling CPA questions. CPA exam questions. So you take the CPA exam, you go to tell somebody that what the questions are, we're on the CPA exam. That's discreditable. Or if I ask, hey, what was on the CPA exam? Let me know what questions were on there. It's an act discreditable. Now, well, you know, you can ask like what topics and that sort of thing, and most of those are already included in the blueprint. But yeah, asking or telling the CPA questions is a no-no. There's other things, you know, don't commit felonies and some of the other stuff that kind of obvious. There used to be a report on people who got kicked out of the ACCT. It's kind of fun to read, and every now and then there'd be a murder or something. Yeah, if you're gonna be CPA, don't murder people. All right, referrals fees. Are not allowed for the auditors. So if you're an auditor, you cannot charge referral fees. Now, if you are doing non-attest functions, consulting, referral fees are allowed if to the client. So you have to tell the client, you know, client asks, is there anyone, you know, who can you tell me to get business insurance from? You say, well, there's this, you know, this place over here, there's Jackie Neubauer or whatever. That's allowed, but you have to tell them, look, yeah, by the way, anyone I send to Jackie Neubauer, I get a referral fee of $20, you know, just so you know. So
I mean, a common example would be like if they recommend like an accounting system, you know, like I know NetSuite software as a service that like if you're an integrator or you're a consultant, they may give you like 10% of the first year's revenue or something.
yeah, and actually that's one of the things that we have in the end here talks about those systems, and and generally speaking, you know, for publicly traded companies, not issues, they can't do that, period. But well, no, I take it back. If they're not auditors, they can. But yeah, it used to be very common with the auditors of putting the CPA, the you know, accounting systems. But and again, as long as you tell them about it, there's nothing wrong. I'm gonna skip some of those partnerships. Personally, there might be minimal stuff on those. I think I talked about this also. Enforcement of the standards, the AICPA, they can't really do much. They can kick you out of this AICPA. They can discipline members, but you don't have to be a member. You know, they can't take your license or anything like that. States can take CPA license. I should say take. What is it called?
The board of examiners or the licensing boards.
Yeah, I think they can revoke a CPA license. So individual states, they can take away CPA license. The SEC and PCAOB, they can revoke a registration. PCOB, they can revoke a registration to audit publicly traded companies, so they can't take away your license. However, they can take away your registration to audit publicly traded companies, which if you're a large CPA firm, that's a definite, you know. But you know, so they can, and they can do other things too. They can limit what you can do. I know that sometimes you hear about an audit firm that is banned from auditing financial institutions because he messed up an audit somewhere or something. You know, so these do come about sometimes, but yeah, they can give fines and all that kind of stuff too. But as far as the enforcement of the standards, you know, the worst things that can happen, basically the states and the SEC are the ones that really are the ones that can do, that can legally do the most damage. ACCT433, kick you out of the club, fine you, that sort of thing. Okay, so this is kind of a non-attest services for audit clients. This is an important overriding idea though, right here, and that is the PCAOB and the ACCT433 do not allow auditors to make management decisions. So you can, you know, you can make recommendations, you can do, you know, work for them. You cannot do actual management decisions. You can't do hiring and fire. You can't do product decisions, and you know, those things that are management decisions, you're not allowed. Why? Because you'd be auditing yourself. Basically, the financial statements are put up by are the results of management's decisions. So if you are basically doing management things, you are not independent. So you, the auditors, and that's for all CPA firms. Basically, you're not allowed to make management decisions. Now, these non-attest services for audit clients. Now, if you're not an auditor, if you're not auditing these, you know, if you're not the auditor of, say, IBM, these rules don't apply to you. If you're doing consulting or whatever for them, that's different. You know, you can do most consulting stuff you can do, but if you are the auditors, then you have restrictions on you, what you can and can't do. And the restrictions are so much that a lot of times, you know, when the Sarbanes-Oxley rules came out, they were so strict that a lot of times CPA firms would give up the audit because they wanted to keep the consulting, because the consulting was way more lucrative than the audit was. So, but anyway, so these are for auditing only. If you're not the auditors, doesn't apply. Okay. Bookkeeping. Can you do it by the PCAOB standards? You can probably guess what this one is. No. AICPA? Yes, you can actually do the bookkeeping for a client and still do the audit. Someone has to approve the journal entries going in. That's a management job, approving journal entries, but you can do the bookkeeping for them as long as somebody else approves journal entries and does the other things that they're supposed to be doing, like, you know, doing the estimating bad debt and all that kind of stuff. Financial or accounting system installation. No. This used to be very common for CPA firms. We need a new accounting system. Oh, where's the CPA firm? They'll do it. AICPA, yes. Generally, it is okay if it is an off-the-shelf accounting system. Reason being is that if it's not internally created. If you made the accounting system yourself, your CPA firm made the accounting system, which by the way they used to do. If your CPA firm made the accounting system, you can't put that in because you'd be auditing yourself. You're auditing your own work. Appraisals and value or valuation. No. Yes, as long as these are not management decisions as far as how they're going to use the assets and that sort of thing. You kind of get a pattern here. Most of the stuff going down. That most of them are going to be no for Sarbanes-Oxley and yes for AICPA. And again, a lot of this, if you think about it, these AICPA professional client, this is for a lot of extra smaller clients. So, a lot of times they will, you're allowed to do more for them, basically. Internal audit function of the client, no. This is one of those things I could not believe that they actually did. And for the AICPA, I think that's a no too. I believe that's a no also. I'll look that one up. I'll write that down. I thought that one was also a no. But anyway, the internal audit. Now, if you're not the auditors, you can do it. Now, the funny thing on that, I can't believe that that's cheaper than having your own audit staff. CPA firms charge huge amounts an hour and stuff. It'd be hard to imagine an internal audit being done by a CPA firm that wasn't just twice as expensive as it needed to be. Management or human resource recommendations, generally no. And for both of those, no, as far as actually hiring people. Now, as far as recommendations, it becomes a little bit blurry because you're not actually hiring it for them. But a lot of times, these management human resource recommendations, especially for the publicly traded companies, when companies needed to get a chief financial officer or something like that, they would get the CPA firm to do a search for them. And that person that they bring in is probably more likely, somewhat friendly with the CPA firm than was expected. So management and human resource recommendations generally no, but it is definitely not for hiring. All right, investment service recommendations, no. Yes for AICPA, as long as they are not specific. If it's simply asset allocation or something like that, you can say, okay, you should put this much in the stock market, that sort of thing. You're not actually giving them specific instruments to buy. That's okay. All right. Legal services, not related to auditing. No. And this one is yes by default. They actually don't have any rules on it. The AICPA does not have any rules on it. So it's yes, but it's also kind of a gray area. It isn't like they gave you a stamp of approval saying that it's allowed, but they also don't have any, they don't say anything on it. Okay. Tax planning for common issues, yes and yes. You can give basic tax, common tax issues. What would be the depreciation on those? What would be the whatever it is, common stuff that is, that you normally do, following the tax code, basically. Unusual or aggressive. No and no, and this is because I can do this right. Oops. Auditors cannot be advocates for the client. And if you are doing unusual or aggressive tax issues, you may very well be called in to make kind of presentations or whatever. You cannot be an advocate for the client. You know, the client might say, can you just talk to my banker and see if just tell them that we do good work and then we're doing, the kind of stuff that we talked about before. You can't do it.
I thought that the firms, though, when they're looking at mergers and acquisitions deals, will look for a tax advantaged structure. The bankers may suggest some, but will say you need to check with your, tax advisors. They may even ask for an opinion. Are you saying the audit firm can't be the same one to do that? You'd have to go to another firm?
I'm not sure what you're asking.
So if Disney's going to sell or if Disney's going to buy ESPN as part of their, and it's an S corp and they're making sure they can do a step up in the basis. This is a true case. $2 billion step up tax-free transaction. I'm sure they talked to some accountant in there to make sure that they weren't going to lose that benefit. I'm just wondering, can they use their audit firm or they'd have to go somewhere else?
Something like that, they definitely have to have somebody else do it.
Okay. Because they're looking for basically tax advice, but it's unusual.
You're absolutely right that they would definitely get somebody. But and again, as long as they're not the auditors, it's fine.
Okay.
Yeah. If it's an aggressive or unusual, which sounds like it probably would be, they can't do it. And again, you can't advocate for your client. Mergers and acquisitions is actually pretty interesting kind of work. I think I told you guys I was at some boring CEU credit things, and I wandered into a mergers and acquisitions. It's actually very interesting.
Yeah, I mean, I took a whole class in business school on it, and I couldn't believe, you could call them loopholes in the tax code, or you could just say that they're there for these purposes. But tax-free acquisitions where one party, converts their stock into another party's and there's no taxes paid. It's fascinating.
Yeah, they used to be called the equity method. You can't do that in accounting anymore, but there are still some around that used to be the equity. But anyway, yeah, it would be as if you had two companies, and if you do, like you said, exchange stock, it's as if those two companies existed for 100 years with ownership of both.
It's like you rolled in a subsidiary, and essentially, as long as there's no boot received, as long as there was no cash, you can consolidate debt, you can issue new shares, you can do all sorts of things, and it just looks like a merger that didn't create a taxable event. I mean,
they treat it as if it was always together. Yeah, those two firms are always together because the stock is eternal or whatever. It's a weird concept, but yeah, if you're exchanging stock, on that same kind of topic, what they used to do, they can't do it as much anymore. Companies that lost a whole bunch of money would be companies that have, millions and whatever.
Net operating loss carryforwards. Yeah.
And they used to be able to, the companies used to buy them. The actual losses would have a value. They can't do that so much anymore.
Yeah, they have a thing now, unless the ownership stays the same over 5 years.
Yeah, but it used to be, you'd have these companies that were bankrupt that would actually have some cash value with it, because we lost $600 million. Yeah, I want that company. All right. Individual tax services for officers. No, used to be very common. And yes, on the ICPA. It used to be if you went to audit IBM, part of the deal would be that you do the taxes for people on the board, not the board of directors, but upper management and stuff. That you do the taxes for everybody, and you can't do that anymore. They used to do that. There was a case where they, I forget what firm it was, that they had a couple people that upper management that had their auditors do their taxes, and rather than getting rid of the auditor, they fired the two upper management people. so that there was no conflict of interest or whatever. But anyway, okay. So let's wrap this up. Oh, so go ahead. So what is we? We don't have a. So you said what, 16, 17, and 18 for the multiple choice? Yeah, so just go ahead and enter those. And put that on here. And we'll take a break and come back, and we'll see how far we get in this. Any other one. I think we should be able to finish it, but famous last words. Okay, so let's say be back at what time is it? So if I say 7:10, do 7:10. Yeah, 7:10 we'll start in on chapters 17 and 18. Hopefully that won't. I set it up a little bit differently. I might jump right into the 18. Yeah, I set it up a little differently, and where I think I might actually verbally talk about the ideas, and then we answer the questions. I'm thinking that might be a better way of doing it. Anyway, be back at 7:10. Okay, I think we will go ahead. I think I'm going to start on chapter 18. We'll come back to chapter 17. Chapter 17 is sort of wrapping up the audit. And 18 is on financial reporting, which is more important. And so we'll go through this. And hopefully, I got it set up as a, I got to close this out. Hold on. You know what's weird about saving the report for these polls is that every single class saves as the same name. Every single poll is the same name for the same class. It's strange. Okay. Oh, man. Here we go. Reporting. So I'm going to go ahead and launch another poll. Okay. And one of the things I'm kind of doing here is making this kind of more the questions have the things that are included, because I say except, so there's only one of these that is not in the report. The reason being is I want to put as much stuff that is in the report in there. Okay, so standard report. We talked about the standard report before. I know it was a long time ago, but so this is a non-public client. This is a non-issuer. Okay, they have all the elements except, you want to guess on which one they don't have?
C?
Yep. Yeah, they, if it's a non-issuer, they do not give an opinion on internal control. They say that they they can use it, they can rely on it in their for their audit opinion, but they give no actual opinion on the internal controls. Okay, standard report for public or issuers.
I don't know what
Is
you
it D?
D will actually be on there. They generally don't have the statement on management fraud. They make no statement on management fraud. They are registered accounts, and it'll say right at the top of the audit report. In fact, they must say on it, this the report of the independent registered auditors. And that registration for publicly traded companies, that's what they can, you have to get registered before you can do an audit of publicly traded companies. Yeah, this is a PCAOB. The PCAOB is a part of the SEC. Okay. So standard reports, these are now called unmodified reports. They're called clean opinions. Okay, so unmodified means clean. They used to be called unqualified, and people were, get confused over, unqualified can have a bad connotation. That is, what they mean is that they didn't qualify. They didn't say, except for this, everything's fine. So unqualified meant, hey, I'm just telling you this, and this is, free of, reasonable assurance, free of material misstatement. Okay, so a clean opinion or standard opinion. So that's not, most companies get these because a bad opinion, a modified opinion doesn't help them. Okay, now emphasis on matter. This used to be have more things in it. Now this emphasis of a matter is a paragraph that gets tacked on to the end of the audit. So it goes at the end of the audit, after the audit. So, the different parts of the audit, it goes at the very end. It does not change the audit opinion. So clean opinion, but with emphasis of a matter. So this is one of those things that is, it doesn't change the opinion. It's still a clean opinion. Now, people getting it might not think it's a clean opinion, but it is. So this is a matter. And they also now have what they call other matters. They've separated these two out. It used to be everything was emphasis of a matter. The new thing is emphasis of a matter or other matter. Other matters, the auditor has discretion. Emphasis of a matter, they don't. Okay. So emphasis of a matter are things that are, they're usually already disclosed in the financial statements in some way. They have to be, and you're emphasizing those things. Okay. So, so going concern, this is when a company is going bankrupt. So this is when a company is going bankrupt. All of these are okay. The only one that is going to be modified a little bit is this B. This is the one that is the exception. And I'm going to talk about, I should make those the same color. So this is the one that is the exception. And this is 1 year from the date it is issued. And that's a new thing. It used to be, if their year end was December 31st, it'd be 1 year to December 31st of the next year. Are they going to go bankrupt within 1 year for the financial statements? Now it's for 1 year from when the audit report is actually issued, which may be in March. Maybe it's March 15th. That means from March 15th to March 15th. So it's a year from the date that it's issued. So this should actually be not from year end. Let me go down here. Oopsie daisy. So it could be, so whatever it is, March 10th or whatever. So it's not from the year end, it is from the date the audit report is issued. So that's kind of a newer one. The international standards are for 2 years. So US standards 1 year, but not from the company's year end anymore, but from the date the audit report is issued a year. And international standards are for 2 years out. And the US standards also go a little bit further than that, even saying a year from the date it's issued, or possibly longer if the auditor feels it's necessary. Now, another thing that is should note here is that companies are now required to put going concern footnote in along with their financial statements. So if there is, this likelihood that they're not going to make it through the next year, they must also put that in the notes of their financial statements. That's why this is called emphasis of a matter. It's already reported, but we're going to emphasize it. We're going to put it in the audit report. This is called a going concern report sometimes, but it's a clean report. It just says they might not make it to the next year. Another one to remember too is you also can consider management's plan. If management says, look, here's what we're going to do. We're going to sell these 2 factories. We're going to, we're going to lay off some people. We're going to do, if they have a plan in place, it looks like they're not going to go bankrupt. You don't need to give them one of these, but you have to evaluate that plan to see, is that plan workable or whatever. There was an airline, they got a going concern, I remember. And the airline, they said, we got this going concern, we disagree with the auditors. We sold off these routes. We, laid off these people. We're, doing the, and the audit firm said, well, if they had those plans in place when we did the audit, they wouldn't have got a going concern. So the plan, if someone has a plan in place, and sometimes it's a wake-up call for a company. Really, we're going bankrupt? Yeah, you don't have enough cash to get you through September. Okay. Emphasis of a matter for accounting principles not consistently applied, which has the following characteristics. Any ideas? So this is when the general accounting principles are not consistently applied. In other words, they change from 1 year to the next. It's not saying that they are not using GAAP. They are using GAAP. But the GAAP is not consistent. It changes from 1 year to the next. So which scenario would they report that in?
Is it A?
Close. No. Yeah, it is changes in accounting estimate. If they change in the life of the asset, that's not actually changing the GAAP. Usually, so for instance, if they're using the straight line method, they say, "Oh, we think machine's going to last for 7 years, but it'll last for 10 or whatever." That's just a change in the estimate, but the actual principle is the same. So changes in estimate.
I thought it was changing like from straight line to double down. That's what I was thinking. So double rate.
And what you're saying actually is not bad. They the new rules on that I believe, and I'll check just to make sure. But the new rules on that is that all changes in depreciation are changes in estimates because it's an allocation. There's a change in an estimated allocation, which I kind of don't agree with. I'm like you, that if they change from, straight line to double decline balance, it's a change in a method. But yeah, they're getting a little more lenient on what they call a change in GAAP. Which I think I know why. I think because they're saying that it's going to be put in the notes and whatever, people should be able to figure it out. But and another thing about these changes and GAAP not consistently applied, I've seen audit reports that had 6 of these tacked on, and I think that that's one of the reasons why they're kind of trying to do away with some of these. Okay. Well, so changes in estimates are generally not in there, and again, they're allowing for more things to be changes in estimates than they used to. If management adopts an unacceptable accounting rule, that's not GAAP. This is when GAAP is not consistently applied. It doesn't mean it's not GAAP, it's just not consistent. They're going from one rule to another. Must be used in the financial statements or immaterial. If it's immaterial, it doesn't have to be used. If it affects something that's immaterial, you generally don't say anything about it. And one of the reasons why you don't say anything about something that's immaterial is that it can be misleading. And it's actually D. It's used even if management is justified and the new principle is preferred. So a new accounting rule comes out, they get one of these tacked on. Again, the audit report is clean. Everything's fine. They tack this on the bottom and they say, okay, by the way, they changed from this to that, and it, and that caused, revenues to go down by 19 million, whatever it is. They'll get the numbers in there, but it'll be tacked on the end. It's still a clean opinion. Emphasis of a matter is still a clean opinion. So, and again, I've seen, they have it used to seem like they used to have accounting rules that came out about 10 years ago. Accounting rules came out every week, it seemed like. And the financial statements back then, I know I've seen one where they had 6 on it. I used to bring it up in class and show, here's a clean audit report. And by the way, there's 2 pages of stuff tacked on the bottom. It's still clean. So, but anyway, and I think to get rid of that, to reduce that, they're starting to allow for more things to be changes in estimate rather than changes in accounting principle. Okay, so, and by the way, when they go to a new accounting rule, the company has to use it. They're required to use it. They still get one of these. The company knows this coming. It's not a surprise to them, right? Okay. Other matter. So other matters are when the auditor has discretionary. They can put it in the report or not. These are tacked on the end. They are generally not for things that are already reported. If they're things that are already reported, it'll be an emphasis of a matter. If they're things that are not reported, they will, that's what they call an other matter. And while the audit report is structured in that you have to do it this way, you get clean audit report, these are what must be in there. We all saw that. When it comes to the other matter, that is giving the auditor a little bit of leeway, saying, look, if there's something that's not an emphasis of a matter, but you really think someone should know about it, this is where you put that. This is where you might have it in there. So another matter paragraph is used for uncertainties, which has the following characteristics. So if there are uncertainties, what kind of uncertainties would you put in an other matter? Which one of those do you think would be the kinds that you would put, you'd actually tack on the audit report and say, look, you know, this is something I want you to know about. If you don't want to say, you can put it in chat too. I'll tell you one that it's not. It's not this one. It's not required. These are discretionary. By definition, they're not required. So now going concern is required. Changing in accounting principles, those are required. These are discretionary. They're not required. So it's certainly not D. So of A, B, and C, which ones of these would you probably want to let somebody know, saying, look, you know, here's something that may impact the company, and it's not in the financial statements. It's not in the footnotes or whatever. Oh, come on. Okay, I'm going to reduce it even further. It's not A. You don't report on normal uncertainties. So it's not A and it's not D. So
It's a B?
Actually, if they can be reasonably estimated, they should be in the either the financial statements or the footnotes. So if the uncertainties are, if they can be reasonably estimated, they should be already recorded. It's for these unusual things, unusual uncertainties that you may put on there and say, look, you know, that they do a lot of business in, you know, this part of the world, and maybe it's iffy if they're going to be able to keep that business or whatever it is. You know, things that are not necessarily in the financial statements that you want to bring to their attention, to the reader's attention. So they're usually for things that are not, they cannot be estimated. You know, if they can estimate them, they should put them in the footnotes, or they should actually book them, you know, put them in the financial statements. For instance, lawsuits. If they say, okay, you know, this lawsuit is going to be about $3 million, well, then they should book that. But these are for things that you don't know. Yeah, so there are things that usually are for unusual. Normal things in business, we don't put those in. But for things that are unusual. Okay, additional circumstances. May include all of the following, except. So which one of those things is probably not is not something you'd probably put in the audit report?
I think it's B.
And you are right. Yeah, an inventory item thing could not be verified. That's really in your audit. That's, you know, if it's not material, which if there's a clean opinion, it wouldn't be. You don't put that in there. So an inventory item that couldn't be verified, that's not going to be in there. Again, if it was material, you'd have a different audit opinion. But that didn't be in there. So these other things, if you think about it, these other things are things that can be in there. An important subsequent event, for instance, a merger. So in February, there's a big merger between your client and some other. Well, you want to tell people that, hey, look, by the way, this company's twice as big now. So a merger would be something. Major catastrophe, obviously, weather, depending on where it's at. Fire, that sort of thing. My father-in-law was he was a sales rep for a company that they sold auto parts, and they had two major warehouses. They had a couple little ones, but they had two major warehouses, and the owners, or the manager of the warehouse, brought his son in as temporary work to work on taking inventory, I think it was. And his son wanted to leave, but his dad wouldn't let him. He started a fire. So someone pulled a fire alarm. You can guess what happened next. The whole place burned down. Put that warehouse out of business for whatever. Something like that. Okay, we have two main warehouses and one of them's gone. That happened in whatever. That could be something you put in there. And it's a significant part of related party transactions. Now, those transactions should generally be included in the footnotes, especially if they're material. But you might say, look, 40% of their business, while they're in the footnotes, the 40% of their business is for related party. So that could be something you want to emphasize. And again, that one has discretionary. It does not like these up here where you don't have that discretionary thing. Oh, wait. We have one more here. Which of the following is not true of the group auditor? Okay, this is a little more involved than I thought. You know what? I'm going to do it on a piece of paper over here. Quicker. Okay. So here's the thing about group. This is new terminology, kind of new terminology. So let's say that we have this. We have IBM, and we have CPA firm A is auditing IBM. IBM has a subsidiary. I don't know, whatever the name is. Minico. Okay, so Minico is a subsidiary, but IBM lets them run pretty much on their own. And they have CPA firm B do the audit. Okay, so, IBM, big company, and their subsidiary, Minico, they have a different CPA firm that does the audit on it. So, you're doing the audit report for IBM. In the US, and only in the US, you have the possibility, so this is for firm A. You have the possibility of, in the audit report, saying, by the way, firm B did the audit on the subsidiary. It's sharing a responsibility. Okay, this is the group auditor. You know, the group being all of this. And so they have the, you know, they can put the other CPA firm in the audit report or not. Now, if they put the other CPA firm in the audit report, they still must see if that CPA firm, if they're reputable and all that kind of stuff, they still have to do some legwork on it, but it shares responsibility. If they don't put them in there, they're assuming the responsibility for CPA firm B. And by the way, most clients, a lot of them will insist that they don't put it in there because they, you know, people, they don't like their audit reports being, what am I doing here? They don't like their audit reports being cluttered up with, you know, different audit firms and all that kind of stuff. So a lot of times they'll say, no, you might, and if you don't put it in the report, you're probably gonna have to do some more work on it to make sure. Okay, so the group auditor, so the one auditing, in our case, auditing IBM, and the component auditor relation. What's defining that true about the relationship? Is not true. Oh, I didn't talk about it. It's the, and I'll talk about that in a second. The rest of these are true though. It's the group auditor decides whether to include it. The responsibility not share the group auditor must perform additional procedures. Okay, if you say I'm not going to count on your audit, then you know you have to do more work because now you have to get comfortable with it. And the group auditors are never forced to rely on component auditors' work. If you don't think that a certain part of their work is adequate, then you can go do your own. You know, you look at their work papers and stuff, and you say, okay, you guys didn't do inventory like you're supposed to. You can go do that work on your own. So you're never forced to use theirs. Okay, materiality. I didn't talk about that, and that is an important one. For the audit on IBM, you know, IBM, big company, they probably have a much higher materiality than the subsidiary. You know, maybe what's material here is, I don't know, 100 million. Subsidiary might have a much lower one. Maybe their materiality is 2 million. When you're doing the audit on IBM, you're using the 100 million. They may even give an adverse opinion. Maybe they say that these are misstated by, you know, by 5 million. You know, so they give an adverse opinion. They say, okay, this is misstated by $5 million. Well, that might be material to the subsidiary, and their, you know, their audit report is fine to say that. But to your audit, where the materiality is 5 million, if this is only off by 100 million, if this is only off by 5 million, you're not going to say anything about it. It's not material. Okay. So the materiality of the group level and component level are the same? Generally, no. Because if you think about it, no matter how, you know, what the sizes are, the group is going to be bigger than the subsidiary. Modified opinions. These are bad opinions. A qualified opinion. Did we talk about these before? I thought we did. Maybe I'm wrong. Qualified opinion is the nicest of the bad opinions. It's when the misstatement is material but not pervasive. In other words, it doesn't go throughout the financial statements. So a qualified opinion. These are sometimes called except for opinions. And they're called except for opinions because you say, except for, you tell what's bad, what's wrong with that one account, and then you say everything's fine. So it's qualified. The qualifier is except for, some foreign accounts receivables couldn't be verified or whatever it was. Yeah, so that would be a, it's material, but it's not pervasive. And again, this is for those things that you have something that's material, but the financial statements as a whole are okay. So even though it's material to that one account, it is, it's not material. The financial statements in general are okay. You know, the sales are okay, the income's okay, and whatever. So if somebody calls an except for opinion. So if anyone says that they got an except for opinion, that's what they're talking about. Material misstatement. However, the financial statements are generally okay. Adverse opinion. This is the worst. Oops, what did I do? This is when it's material and it impacts many accounts. And this is when the financial statements are not reliable. Financial statements are misleading. Misleading, not gap. So adverse opinions are the worst ones. And that's a, look, you can't rely on these financial statements. They're misleading, materially misstated, and not fairly presented. And these opinions, by the way, are rare because you always, for these two opinions, you'll always put the dollar amounts. You know, when you say that they're misstated, that means you know that they are off by a certain dollar amount, right? It's material misstatement. So both of these would have that's not right. Oopsie daisy. So, you know, they're both, I should say, known dollar amounts. So you can put that right in the report. By doing that, it doesn't make sense for the company not to make the corrections. You know, if you're going to put it in the audit report, their revenues are misstated by 38 million, the game's up, right? You know, so there's no reason for them not to make the correction, and that's the hope. The hope is that they go, okay, if you're going to give us an adverse opinion, we'll make the corrections. So these are modified. So unmodified, good. Modified, bad. Disclaimer is an odd one. Disclaimer is really no opinion. And it's no opinion because you can't get enough evidence. So a disclaimer is no opinion. So it would be D. The statement amount, if any, is unknown. You're not saying the financial statements are misstated. You're saying that you don't know. Okay. Let's play let's play an ethics game. Suppose you got a client that's going to get an adverse opinion, and they tell you, don't give me an adverse opinion. Give me a disclaimer. Right? Disclaimer, you don't know. So don't give an adverse opinion. Just give a disclaimer. Can you do it?
No.
No. A disclaimer means that you don't know. Adverse, you do. So, you know, that's actually a type of fraud for you to say that you don't know, you know, that the financial statements are whether they're misstated or not. You do know. So you cannot bargain away an adverse opinion for a disclaimer. Okay. Along these same, oh, I gotta give you guys a new, hold on. What time is it? Oh, we got a few more minutes. How much more do we have here? 4 questions, we can do it. All right, I gotta give you, so hopefully you guys are up on the, did I give you guys a poll?
We have a poll. It just stops at question 10.
Okay. Yeah, so go ahead and, yeah, go ahead and enter that. So enter the 1 through 10, if you would. And then I'm gonna launch it. Okay, everybody's in. Good. This is that weird thing I gotta do. Okay. Okay, so pause. Okay, I think you guys got it right.
Yeah, we have the new poll.
Okay. Okay, so question 11. Which type of scope limitation is considered the most serious? Okay, a scope limitation is when you can't get the information you want. So it could come about through a few different ways. It could be that the owner doesn't let you, or whoever's running the company doesn't let you get the information. It could be that they had a fire, you know, something along those, or a theft. You know, someone stole the computers. That you can't get the information. It could also be a timing thing that maybe you didn't, you know, they, for whatever reason, you are doing the audit. They give you a call in January. Their year end was December. You know, that could be a problem too, because you can't be there at year end to do the inventory and all that kind of stuff. So which type of scope limitation is the most serious? Anyone?
See,
Yeah.
See, I'm sorry, my voice is gone.
Oh, no. You can put it in chat too. I'm so sorry. Yeah, if the client refuses, right, and the idea is, this is a clear indication that there's some problem. There's gonna be a reason why they don't want you talking to a lawyer. Investigation, whatever. Whenever somebody says, "I don't want you doing that," I don't want you looking in this closet. Well, the first thing I do is look in the closet because there's obviously something they don't want you to see. So yeah, client impose limitation, and also remember that this also reflects on the client themselves. That the client themselves may lack integrity. So this is the most serious of those three. The first one is obviously less serious because it's beyond the control of the client. And they probably didn't want a fire to happen or a theft, but it happened. This one is a little bit, it is kind of usually the fault of the client. It can be anyways, a little more serious, but still, it's not, it isn't like they wanted to do that. So the C is definitely the one that has it. Okay, a scope limitation that is deemed possibly material and possibly and pervasive, goes throughout. We'll get kind of an opinion. So again, it's a scope limitation. You can't see what they're doing. You don't know. Well, first of all, it's going to knock out these two. These two say that you do know. You know what they are misstated by. So it kind of leaves the only one is that it's a disclaimer. These two, what the amount is. It's off by 38 million. A clean opinion, obviously that's not what you're going to give if they have a possibly material and pervasive scope limitation. Okay, a scope limitation that is going to be possibly material, but not pervasive. This is one that is not not so intuitive. Let's eliminate the possibility part here. Suppose it was material, but not pervasive. What kind of a report up here would they get?
That would be qualified.
Yeah, and they can get a qualified for a scope limitation also. Now, it's up to the auditor to decide that, but it is possible that they get a qualified, and the qualified opinion would read something along the lines of, we were not able to verify whatever it is in this account. They put a dollar amount, but not saying that it's off by that amount, but saying that they couldn't verify this material amount. But it's only this one, it's only these accounts receivable. We can't get a confirmation on these, whatever, foreign accounts receivable from this government or whatever it is, that you can give them a qualified for a scope limitation. This is not allowed if it's a client imposed. If it's a client imposed, they have to give a disclaimer. But if it's a circumstance imposed, it is possible if it's material but not for, it's only for one account, that they can do it. Okay, 14, a scope limitation that is deemed to be not material and not pervasive. Which type of opinion?
A.
Yep, clean audit report. So, maybe they have a, they got a new desk for the person that was doing petty cash, and they took out the old desk and they forgot to take the receipts out of it, so they lost all the receipts for petty cash. Who cares? You can't verify petty cash payments, but it's not material, it's petty by definition, so don't worry about it. Okay, I think let's stop there. So here's what we're going to do. I'm going to send out an exam. It'll be over. We didn't do chapter 17. We did 18 and 19. So I will make up an 18 and 19 exam and send that out. I should get it out by tomorrow. So yeah, I doubt I get out tonight. There's a lot in there. But so I will get out only over the stuff we covered for chapter 19 handout and then the chapter 17 and 18. So chapter 17 and 18 handout, you do not need to do 17. Only the 18th part of the handout. And I'm going to make sure that I put that in also in the these two handouts.
Blackbird still doesn't have a spot, correct, for this week's test. Is that correct?
Yeah, once I get off the air here, I'm going to put in the sampling practice exam, chapter 6 and 7 exam, chapter 6 and 7 handout, chapter 19 handout, chapter 17 and 18 handout. What the heck have I been doing? And then I will also put the chapter 18 and 19 exam, but not until I'll put the drop for it in, and then
But we're not gonna have to turn in the handouts, right? Because we did the surveys.
oh
That's what you had said last time.
yeah, you're right. Yeah, so if you're here and you did those, I will use, so for 19 and 18. Yes, that is true. So those two you will not need to turn in. It's still going to be there, but the grades will already be in for them. And then, so then the chapter 17, 19 exam. Okay. So what do we have? Okay. Yeah. So turn in the multiple choice questions 1 through 4, and you for 5 through whatever you put anything in for those. So if you have not turned in the multiple choice for I do here. Okay, somebody has not turned it in yet.
Turn what in, Professor?
Questions 11 through 14. So up on the screen, and then just put in for 15 through 20. You can put in anything, but I think there is one on there. I think there's one for no question exists or something like that. But you can put anything in for those. Okay, very good. All right, guys. So tomorrow I should be sending out an exam that will be the last one. The last class is generally going to be not required. You're absolutely welcome to come to it, and you can ask any questions you want, obviously, during that period of time. But I'm going to leave that a little bit open for people cleaning up and getting stuff done if they have questions for it. But I have nothing. I don't plan on giving any new material. Again, if there's something that you want to go more in depth on, I'll be more than happy to talk about it. Or I have virtually handouts and stuff for everything in Audit, so I can pull those up too. So anyway, so next class, it's not required. I will make the exam will be due on May 7th. And the last day to turn anything in is May 10th. Let me write that down. Oh wait,
When do the grades actually post, or when do you have to turn them in?
It's pretty soon after that. I want to say it's 2 or 3 days after
Because the graduation's actually on the 7th. I'm graduating, so it's strange.
Yeah, well, you know how that goes. I mean, they hand you some piece of paper that says,
Well, digitally.
oh, they don't even hand you anything?
It's Zoom.
Oh.
No.
It's a virtual graduation. They gave us a grad walk back in March, but it was basically just taking your pictures in the cap and gown.
Okay. All right.
Or you gave them, yeah.
Well, you know, I mean, even at the graduations, they hand you a thing that says basically, you know, you may have already graduated. You know, it doesn't, you know, it isn't like back in the old days where they really give you the thing or not. You know. Let's see. All right. So we'll do the chapter. Oops. I'm gonna do it in numerical order. Chapter 18, 19 exam. We do 19 first. But on May 7th, and the is May 10th at midnight. Monday.
You're saying the next class is not actually a class, it's more like office hours? It's not required?
Yeah, it's not required. You're welcome to. I mean, if there's something you want to cover that we didn't cover, I have no problem doing that. Yeah, I think in the future though, I think you know, it's, I don't know, there's a learning process, and I apologize for that. But I think in the future, what I'm going to do is make this more multiple choice based class, just because you can move so much faster. I mean, we went through chapter 18, and that one would have been drug out for a while if we had actually gone through and written everything out. You know, wrote a little bit on it, but I think something like this class, if, you know, if and when I do this in the future, it's going to be more along those lines. So anyway, I apologize. I mean, I'm a classroom teacher. That's what I'm used to doing. So anyway, but yeah, so we turned in the homework on, so by Friday, they said, and by the way, in the classroom, I would always do that too. I would always, the last day of class, basically, if everyone was doing their work, you know, you could come, but you didn't have to. Whereas I try to get as many of the people who need more help to get through it. So, all right. Any questions on this? Okay, so I'll make up the chapter 18 and 19 exam, and I should send that out by tomorrow. And be doing on the 7th, and everything for the class must be turned in by the 10th. But you know, I do want to talk about one more thing, and that's one of the exam. I think the exam. I think everyone has turned this exam in, but the exam. Let me. Pull up the exam. It was. Okay, this is one I want to talk about just a little bit. Chapter 3 and 4 exam. I think everyone has this in there. Everyone's got one here. This is one with the inventory. Hello?
Yeah, I got it. going to my dentist appointment.
Oh, 8:30?
Yeah,
Okay, I'll be there.
okay.
Sorry. And this is for the one with the purchase inventory throughout the year. This one. Like includes the interest payments to the supplier in the cost of the inventory. Now, they're quantitatively immaterial. Now, first everybody got that this was that they're not supposed to be doing this. They're not supposed to be putting the interest payments into the cost of goods sold, inflating the cost of the inventory and the cost of goods sold and all that. Okay, so there is something else about this though that is maybe not as apparent, but one can include the interest payments to the suppliers and the cost of inventory. What is there beyond the dollar amounts? What does this indicate? What does it indicate that is beyond simply, these interest payments, what they say are not material to the inventory? But it does show something else. What is it? Let me ask you a different. Yeah, sure. Okay.
Is it because the account is linked to the supplier?
It could be, but the question comes, well, why are they doing it? Why are they doing it? Everyone knows you don't put interest payments into the cost of inventory, and and it isn't like they're going to charge you interest on each item. It isn't like it's going to be included. It's going to be separate. So this would take some work to put these interest payments into the inventory. So why would they do it? Why would they go through the hassle of allocating somehow interest payments into the inventory?
I mean, supplier financing is always a part of like working capital. So in other words, like your invoices aren't due right away, but the idea that you want longer terms, so like instead of 30 days, they're willing to give you 90 days, but it's 1% or whatever. It's another form of financing, but it's not. I wouldn't say it's necessarily like it's not like underhanded or anything.
Well, okay, well, no, but it isn't that it's unusual for a supplier to give that. That's not unusual at all. The interest payments, though, being put in the cost of inventory.
Well, so the idea that you get a bill that says if you pay it in net 10, you get a 3% discount, or you pay it in 30 days, you don't pay anything, and then you pay it in 90 days, you pay an interest charge. In theory, you should show your discounts, but you don't. I thought you have a choice to either recognize, as long as you're consistent.
If they're interest payments,
Yeah.
they're not so big. And so this is their things for the purchase of inventory, and they cannot take loans from any other source. This indicates.
You know what? The key here, I think, is the sentence right before. Interest on the outstanding balance is different than interest per invoice.
Yeah. So
So if you're aggregating at the end of the month outstanding balances and whatever, that's like a revolver.
Right.
Like you have a rolling outstanding floating loan.
So why do you think they did this?
It's another way to get financing without triggering their covenants, without breaking the covenants of the first
exactly
one.
it. This shows that they had knowledge that they were in violation of the contract. There's no reason to put those interest. If they just put interest expense, it would show that they didn't, they didn't think they were in violation of the thing. But because someone trying to hide it, can show that they have a,
They just called me, I'm late.
okay.
My
all right.
appointment's at 8:15.
Oh, okay. All right, I gotta take someone to the dentist. My wife. My
Oh, geez.
wife. So anyways, I will shut
What
up.
was this on, by the way?
Sorry?
Which test was this?
This was 3 and 4. Yeah, this would be materiality and all that kind of stuff. Yeah. So anyway, okay, I gotta get here. So I will sign off to you guys, and I will I'll send out that test as soon as I can, and I gotta take someone to the dentist right now.
All right, see you.
All right, guys,
Good luck.
have a good, and if I don't see you guys, appreciate it, and I hopefully I'll see you guys in the future. All right, bye.